Imagine the one investor on earth who does the dumbest thing possible. He never buys when things look good. He waits. He waits until the headlines turn ugly. Crash. Sell off. Get out now. Only then, when every screen is red and every anchor is yelling, does he put his money in. Buy the panic. Every time. You'd call him reckless. The poster child for catching a falling knife. But here's the part nobody tells you. Over the long run, he quietly beats almost everyone you know. Today we're running the numbers on the investor who only buys when the news says sell, against the investor who only buys when the news says it's safe, and the one who waits for the all clear and never moves at all. Real research, real data. Quick thing first. I'm Uncle Walt. I'm not your advisor. This isn't advice. I just ran the math. Stick around, because there's one number near the end that should change how you read a scary headline forever. 3 people, same starting money, same plain S&P 500 index fund, same goal, retire without running out. The only thing different is when they choose to buy. Bad News Nico only invests when the headline screams sell. Headline Harold only invests when the news feels good and the market feels safe. Sideline Sam waits for certainty before he commits a single dollar. No tricks. Same fund, same fees, same decades. We're just changing the moment they hit buy. Now who should win? Your gut says Harold. Harold's careful. He buys when the economy is strong, when the experts are calm, when it feels responsible. Nico looks insane. He's buying into recessions, crashes, and front-page fear. But that feeling, the one that says wait until it's safe, is the most expensive feeling in investing. Here's why. Markets don't hand out discounts when everyone feels good. They hand out discounts when everyone is scared. When the news says sell, prices are usually already falling. That's the whole point. Nico isn't buying high. He's buying the exact same fund Harold buys. On sale. Call it the fear discount. The market quietly marks everything down at the precise moment the headlines make it impossible to buy. And almost nobody takes the deal. Now watch what happens to the timing. The best days in the stock market do not happen on calm, sunny afternoons. JP Morgan looked at 20 years of S&P 500 data. 7 of the 10 best days happened within 2 weeks of the 10 worst days. Read that again. The biggest up days sit right next to the scariest down days. Hartford Funds found that roughly 76% of the market's best days landed during a bear market or in the first 2 months of a new one. In plain English, the market's best days hide inside its worst headlines. And missing them is brutal. JP Morgan ran the math on a simple $10,000 investment over the last 20 years. Stay fully invested, and it grew to about $75,000. Miss only the 10 best days, and you end up near $34,000. Miss the 20 best days, and you're down around $21,000. That's less than a third of the result for sitting out a handful of days. And remember where those days live, right next to the worst ones. So when Harold waits for things to feel safe, he isn't avoiding the danger. He's standing in the parking lot while the recovery happens inside. Take March 2020. The market fell 34% in about 5 weeks. The fastest crash of its kind in history. Every headline said the world was ending. A lot of people did the responsible thing and sold to wait it out. On March 24th, 3 days after the bottom, the S&P 500 jumped 9.4% in a single day. If you sold on the 16th to feel safe, you missed it. Over the next year, the market climbed about 76% off that low, one of the best 12 months for stocks since before World War II. It happened while the news was at its worst. That's not a fluke. That's the pattern. So why do we get this wrong every single time? It's wiring. We feel a loss about twice as hard as we feel the same size gain. So when the headlines turn red, your brain doesn't see a discount. It sees danger, and it screams, "Get out." That instinct kept your ancestors alive. It quietly wrecks your retirement. Because the moment that feels the most dangerous is usually the moment the market is on sale. Now let's talk about Sam, the one waiting for the all clear. The all clear never rings a bell. By the time the headlines say it's safe again, the discount is gone and prices are already back up. And while Sam waits, inflation quietly eats his cash. Every year, no crash required. He never loses money on a scary red day. He loses it slowly, in a way that never makes the news. Here's the number I promised you. JP Morgan, using University of Michigan consumer sentiment going back about 50 years, measured what happened after people felt their best and after they felt their worst. Buy when confidence hit a peak, when everything felt great, and the next 12 months returned about 3.5% on average. Buy when confidence hit a rock-bottom trough, when the mood was darkest, and the next 12 months returned about 24.1%. Say that out loud. 3.5% for buying the good news, 24% for buying the bad. That gap is the fear discount, measured. Now, if I stopped right here, I'd be doing exactly what every finance guy on the internet does, selling you one side. So here's the honest version. Buying bad news is not magic, and there are real ways it breaks. 1. This works for a broad index, not for any single stock. A scary headline about the whole market is usually noise. A scary headline about one company can be the truth on its way to zero. The index survives. Individual companies don't always. 2. It only works if you actually have cash ready and the stomach to use it. Everybody plans to buy the dip. Almost nobody does, because when the dip shows up, it doesn't feel like a discount. It feels like the start of something worse. 3. All of this leans on the American market, which kept recovering. Japan's market peaked in 1989 and did not make a new high for more than 30 years. Buying every panic in a market in long decline is a very different story. So no, the word sell in a headline is not automatically a green light. Sometimes the bad news really is the beginning. You can't know which one it is in the moment. That's the part nobody can sell you. But step back from the math, and here's the real lesson. The market doesn't punish people for being scared. It charges them for wanting to feel safe first. The trap was never the crash. The trap is waiting for permission that never comes. Nico isn't braver than you. He just stopped treating a scary headline as a reason to wait and started treating it as a price tag. Consistency beats comfort. Every single time. If this made you rethink the last headline that scared you out of the market, do me a favor and subscribe so Uncle Walt can keep running these numbers with you. And tell me down in the comments, what's the last headline that talked you out of buying? Be honest. No judgment. We've all got one.